As many traders have experienced, identifying a valid order block is only half the battle. The real challenge is understanding why price doesn't always mitigate these areas, and more importantly, how to capitalize on it. In this episode, we are going to fully cover the order flow concept and set up a trading strategy with an optimized entry model. If you're tired of missing out on potential profits because your identified order block didn't mitigate as expected, then this video is for you. By the end of this video, you'll have a solid understanding of order flow and a powerful trading strategy that will help you make better trading decisions and increase your profitability. So traders, if that's something you're interested in, please give this video a thumbs up to show your support, and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. Traders often wonder why a perfect order block identified in the market is not mitigated by price, especially when the market continues in the anticipated direction. Understanding order flows is essential to answer this question. While order blocks provide valuable insights, they do not guarantee price behavior. Factors such as market sentiment, economic conditions, and supply and demand dynamics also influence price movements. Make sure to watch this episode until the end as we fully cover the order flow concept. Additionally, we will set up a trading strategy and introduce you to an optimized entry model using order flow. This will provide valuable insights and practical guidance for your trading approach. What is the precise definition of order flow? Order flow refers to areas of extreme demand or supply in which the total volume of trades being executed includes many buy and sell orders. It also includes the order block, which is a specific price level where a significant number of buy or sell orders were previously executed. By analyzing order flow, traders can detect potential market directions and identify key levels of supply and demand. Now let's see how we can identify order flows in the market. Order flow refers to the area where buying or selling pressure is building up before a rally or a break of a market structure. The bearish order flow refers to an area on a chart that contains bullish candles, typically 2 or more, created before a sudden and significant bearish movement toward the downside, and the bullish order flow is the zone that contains bearish candles created before a sharp or intense bullish movement toward the upside. By using order flow zones as a point of interest, traders can identify potential entry and exit points. For example, the bearish order flow zone we mentioned earlier can be used as an entry point for a short trade, as it indicates a strong selling pressure in the market. Let's dive into the details of order flow. In this downtrend example, we can see that the price formed a low point, then moved up to gather liquidity above this structure. Suddenly, the price sharply dropped and broke the previous structure. This zone where the price gathered liquidity and then sharply dropped from it is known as the order flow zone. It represents the last buying momentum before the price sharply moved downwards, breaking the previous low. It's important to note that an order flow zone consists of at least 2 candles, and we're not referring to a single candle. Also, we have an order block right here, inside the order flow zone, that belongs to BOS's movement. As you can see, an order block is a refined version of an order flow zone. It's not uncommon for traders to wonder why the market didn't respect an order block, even if it was in line with your plan. So there is the main reason that price did not mitigate the order blocks, and that is the order flow, because order blocks are mostly located at the extreme end of an order flow zone, and price can reverse direction before reaching the order block. It's important to remember that order blocks are just one aspect of order flow, and should not be solely relied upon for trading decisions. Let's move forward. In the following, the price retraced back to the inducement zone and showed a tiny pullback before suddenly pushing upwards, hitting the stop loss of traders who had entered the market by selling in the inducement zone. After taking the liquidity, the price continued its upward movement until it reached the order flow zone. At this point, it changed its direction to the downside and continued its primary trend. Once again, we have an order flow zone here. This particular zone represents the last moment of buying before the price drops and created a BOS. At the extreme of the order flow zone, we have an order block. So, this scenario highlights the fact that price tends to respect the order flow zone more than order blocks. It's important to note that we use order blocks to optimize our trading strategies by identifying an optimized zone of order flows to set up our entry point and also to minimize our stop loss margin. This approach provides a higher reward-to-risk ratio, which is an essential aspect of successful trading. As you can see, we can easily spot these order flows. But before we move on, let's briefly explain the concept of inducement areas. We have covered this topic in greater detail in an exclusive video on our YouTube channel, which I will link to in the description for those who want to learn more. For now, we will provide a quick breakdown of inducement areas. In this scenario, we can see that the price touched the upper order flow and then moved downwards without breaking the recent structure. Later, there was a small pullback to the upside, followed by a downside move that resulted in a break of structure. Now, we have an unmitigated order flow zone here, which could potentially reverse the price. Additionally, there is another unmitigated zone near the break of structure, which often confuses traders about which zone to trade. As we have discussed in previous episodes, inducement areas are created by large financial institutions and smart money traders like central banks. They are designed to deceive retail traders into taking buy or sell positions in the market, ultimately creating more liquidity for them. So, it's essential to be aware of these areas and understand their potential impact on the market. For more detailed information on inducement zones, we have an exclusive video on our YouTube channel, which we will link in the description. For us, this order flow represents an inducement level. Price attempted to mitigate the upper order flow, but instead it rapidly dropped and broke the recent structure to the downside. This resulted in the creation of a fake order flow and order block. The reason this is an inducement level is because it appears that price was artificially manipulated in order to deceive traders and create more liquidity for big smart money traders, such as central banks and large financial institutions. Now let's have a quick breakdown of the bullish order flow structure. In this scenario, we can see that the market is in an uptrend, creating higher highs and higher lows. There is a break of structure where the price broke the previous high. So, this zone is the last selling momentum before price rose back up and created a BOS by breaking the high. So we spotted the order flow zone. Now, at this point, we can see an order block located in the area. But despite that, the price did not respect it and instead reversed from the order flow zone and pushed to the upside. As a trader, you may be waiting for the price to come back down and mitigate the order block, giving you an opportunity to enter the market long. However, this approach may cause you to miss out on profitable trades because the price may not come back down and continue in its upward direction. This delay in waiting for the price to return to the order block can cause you to miss out on other trading opportunities that may arise during this time. In the following, we once again have another BOS. As you can see, there is an order block at the extreme point of this bullish order flow. After price mitigated the order flow, it quickly reversed to the upside and continued its upward movement. If we had placed a buy limit order at the order block zone, it would not have been activated, and we would have missed out on the perfect upward movement of the price. By waiting for the price to come back down and activate our order, we probably would have missed the price's perfect movement to the upside. Before diving into the real chart and seeing how we can identify order flows, it's important to note a crucial step in your trading journey: backtesting your strategies. Before applying any strategy to your real account, it's recommended that you backtest it at least 100 times. This is because a strategy's win rate is dependent on various factors, such as market conditions, trader psychology, trading sessions, risk management, and time frame. Let's take a look at some real order flow examples on the price chart and see how we can spot them in the market. So we have the Euro-Dollar 1-hour time frame price chart displayed on the screen. It's worth noting that you can identify order flows on any time frame, and it's not dependent on the time frame you choose. If you're using a higher time frame to spot order flows, you can always switch to lower time frames for entry opportunities. If we look at the top left of the screen, we can see that there was a break of structure. As we've mentioned before, a bearish order flow refers to an area on the chart that contains bullish candles created before a significant bearish movement. This zone is the last point where buying momentum was present before the price dropped suddenly to the downside. Essentially, it's an area where buyers who entered the market just before the price started to drop are likely to have placed their orders, creating a potential resistance zone for the price to overcome if it wants to continue moving downwards. If we move our attention a bit lower on the chart, we can see a bearish order flow zone that was created near the BOS. As previously mentioned, this order flow is an inducement level created by large financial institutions like banks to deceive retail traders into entering short positions, thereby providing more liquidity for them. However, as we can see, the price did not respect this order flow zone and instead hit the stop loss of traders who had entered short in this zone. Now, if we take a closer look at the order block of this BOS, it's clear that the price sharply moved downwards without mitigating it. However, many traders were waiting for the price to retrace back up to the bearish order block and provide them an opportunity to enter the market with short positions. But as you can see, the price reversed from the order flow and pushed downwards without reaching the order block, despite their expectations. Hence, it's not always necessary for the price to mitigate the order blocks before it moves in the opposite direction. Same thing happened here at this point. As you can see, the market created another break of structure. The last buying momentum before price broke, the structure created another order flow. As you can see, after reaching the order flow, price changed its direction and pushed to the downside. It appears that we have another BOS on this chart where price created a zone containing the last buying momentum candles before it pushed to the downside and created the BOS. As you can see, we have marked it up on the chart as an order flow. Here, we have another break of structure, and this zone represents the last buying momentum before the price dropped to the downside, so we highlight it as the order flow. If we highlight this order block, we can see that price, after mitigating both the order block and the order flow, reversed and pushed to the downside. Here, we have yet another break of structure, and we can easily spot the order flow. Additionally, we can identify another order block and order flow a little lower on the chart. However, price did not show respect to the second order flow, and instead acted as an inducement. This is because there is an unmitigated extreme order flow just above it, and price was likely attempting to sweep the liquidity that had gathered above it. Now, we have become adept at spotting the order flows on the chart with ease. In the next topic, we will explore how the order flow concept can be utilized to manage a profitable trading strategy and execute trades effectively. Suppose price has formed a bullish structure to the upside, as depicted in this example. By examining this structure closely, we can easily identify the order flows within it. Now, our approach is to wait for the price to reach the extreme order flow on the higher time frame. Once it reaches that area, we can zoom into a lower time frame and look for a major change of character in the price action. After identifying a valid change of character, the next step is to highlight the order block generated by the Chalk's wave on the lower time frame. At this stage, we can place a buy order at the highest point within the order block zone. To manage risk, our stop loss should be set a few pips below the lowest point of the zone. As for the take profit level, we have the option to target either the most recent unmitigated supply zone or the swing high. By following this trading strategy, we aim to capitalize on the bullish order flow and maximize our potential profits while effectively managing risk. Let's go ahead and see a real example. Here we have the Euro-Dollar 1-hour time frame chart, where we can see the following price action. Initially, the price broke the recent structure to the downside, experienced a temporary rise, and subsequently reversed from the bearish order flow zone. It's important to note that the sell orders placed at the corresponding order block, executed by the smart money concept traders, were not activated. Following this, the price sharply declined, creating another break of structure with 3 red candles and leaving behind a significant inefficiency. At this point, our focus should be on identifying the bearish order flow, which was formed during the downward rally. This zone represents the last buying momentum before the price's downward movement. Now that we have highlighted our point of interest, the next step is to patiently wait for the price to reach the order flow area. As you can see on the chart, the price rapidly pushed to the upside, penetrating into the order flow zone with a powerful white candle. In the next step, we zoom into the 1-minute time frame to gain more clarity and look for a major change of character. Here, we have the 1-minute time frame chart. As you can see, price created a major change of character by breaking this structure and also left an incredible inefficiency behind. So in the next step, I'm going to highlight the order block generated by the Chalk's wave. Now we have detected our point of interest, so next we should place our sell limit order here, adjust our stop loss a couple of pip above the highest point of the zone, and I'm going to target this swing low as the take profit. This is where we believe price will head to. Our sell limit order has been activated and we are officially in the market. Now it's time to sit back and watch how things unfold. As predicted, the price went down after the sell limit was triggered and eventually hit our take-profit target. By utilizing the order flow concept and executing a well-defined trading plan, we were able to enter the market at an opportune moment and capture a profitable trade. This demonstrates the effectiveness of incorporating order flow analysis into our trading strategy. Remember that trading is not just about making profits, but also about managing risks and being disciplined. It takes time and practice to become a successful trader, so don't get discouraged by losses and always keep learning and improving your skills. Keep up the good work, and I wish you all the best in your trading journey. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.